Good morning, ladies and gentlemen, and we are at the beginning of the new week, exactly where we finished the last week. So we are still on the horns of the Trump dilemma. The market is trying to work out whether this is a serious guy who means what he says, or whether he is going to welsh on all his promises. The 5-year note is still above just the 1.875% yield, which is the level which has held it ever since 2013, and the market is trying to decide whether to make the final push towards 235 if Trump delivers on his promises. Why are we still in cash? Why are we not doing anything? Well, that is because everything, all the different time frames are still very much not in sync. This is a hourly chart on the 5-year note. It has finally come down and beginning to test the uptrend MAs. On the longer 5-hourly charts, we have a different picture still, where the 200 period moving average is now beginning to be crossed over positively by the 50 period moving average, and the market is still not below the 50 period moving average. And on the dailies, we have a third picture yet, where the market is rejecting the 118.03 level in 5-year notes, which is so pivotal, and we can show you why that is. This is this whole period going all the way back into 2014, which has held it, and we are right at this level. So we have a completely different picture whichever time frame we look at, and that is not something where we feel comfortable with putting on major positions. The market will definitely meander some more over the next few days before the Trump inauguration, before it's ready to make its next move. The same picture is more or less evident in the 10-year and the 30-year, much less so in the 30-year. This is the 10-year. The market now is way above the 200 period moving average, which is now probably going to turn slightly, while on the dailies it is holding this very important level at 125.09, which has held it for such a long time, basically 2 years. It is retesting that level from below. It has corrected a lot of the oversold conditions, but the market is still very, very, very short of fixed income. And that is what really bothers us at the end of the day. The market is very short. Trump hasn't done anything. If he now reneges on any of his promises, we will see a huge squeeze, certainly in the 10-year note, possibly all the way back up to 128.07. But this kind of setup has given us a decent risk-reward level, which is basically selling as close to these highs as possible and stopping ourselves out above them. It's just that at the moment, our level of confidence that we won't get stopped out is very low indeed. And the same picture is evident in the 30 years and the 5 years. Yes, selling around the 118.05, 06 level is good risk reward with a stop above 118.10. but the level of confidence that we won't get stopped out and taken all the way back up towards 120 is very low indeed. But it's worth trying, knowing that the level of confidence is low and that we will probably be whipsawed. But we've got to do something at some stage, and that seems to be the most sensible course of action. Last week we showed you this chart of the yield on the 5-year note superimposed with the dollar, and the relationship is still very much holding, which makes sense naturally. What are we so worried about? We are worried that after another few days of moving in this kind of range, going up towards 190, 195 in yield, or 102 or just above in the DX, we will have formed a very nice head and shoulders top in both contracts, which could signal a move right back towards 96 in the dollar, or indeed towards 145 in yield in the 5-year note. That is what our worry is. On the other hand, our expectations are not for this move to happen, because we have to assume that Trump and his administration are serious and that his promises will be delivered upon. Unfortunately, from all the tweeting that Mr. Trump does, he gives a very different impression about his seriousness. But at the moment, we are willing to give him the benefit of the doubt and lose some money on what he says. That is why we have such a very low level of confidence. The guy seems to be, well, deranged. And we are not very comfortable betting big on promises as opposed to actions. We will do the trade because that is what good risk reward says we should do, but we're very weary, and therefore we're going to have very tight stops on these positions. Moving on to equities, they are now beginning to give us very good risk reward levels. This is the ES, and we have spotted now, let's call it 2240 on a closing basis, as a level where we would, below which we would want to be short. Anywhere above it, we still wish to be long, although not with huge expectations as to the upside. The market is very stretched fundamentally and technically, but we still have no confirmed sell signal of any sort. Volatility really worries us. Let's have a look at that. The ratios of volatility are hugely overbought, indicating we are very near a top, or nearer a top than a bottom. The VXX is making constantly new lows, although we don't have any significant divergences, and is still pointing lower. So we could easily arrive at a situation where we are in the last wave up towards 2300, 2310, 2320, but that is only 2% away from where we are at the moment, and having the volatility in single digits, which is a recipe for disaster. But still, while we are above 2240, we have to give the market the benefit of the doubt and continually buy the dips. 2240 is our line in the sand. In the NQ, we've also spotted a very good level now that the market has managed to reject many times. and that is 49.20, let's call it 49 or 4900 even, let's call it, allowing for a little bit of overshoot. If the NQ, which is our preferred market for longs, stays above 4900 on a closing basis, we see no reason to go against it. We have done very well with this call of outperformance by NQ over ES, and we will stick with it until it tells us that it's no longer valid. TF, the Russell 2000, also gives us now a good risk-reward level, 1346. If the market can keep on sustaining levels above it, we have to give it the benefit of the doubt and say that it's going to go, well, quite a bit higher than 1400. So those are the levels in the sand, and they are also naturally dependent on what the 5 and 10-year notes do and the dollar does as a result. But those are the extremely important levels. Having not done anything significant for the past couple of weeks, it has allowed us to spot the levels at which we want to have or do not have positions. Cash is a position, and we have quite liked being in cash, but I think now having spotted where our ultimate risk and reward levels are, we are ready to start doing some serious trading, having those levels as our backstops. In fundamental land, nothing much has changed. We are still hard up against the 17 times Blue Angel in the S&P 500. The consumer discretionaries are still giving us risk-on signals, as they are above the level of the consumer staples. What is going to take us higher in the S&Ps? Well, consumer discretionaries could do it. Consumer staples could give a bit of a push. Energy we shall forget about. Financials could still be going another 5 to 7% higher, simply because we could have repricing of the Blue Angels as we have had back towards the end of 2016. And healthcare has shown that even a Trump tweet can't, or rather a Trump assertion at the press conference, can't hold it down for very long, because it is fundamentally at a good level for buys in terms of risk reward. So healthcare could push us up. Industrials, well, we doubt industrials will, and they are probably our favored short instrument sector. It does slightly worry us that they are not retracing even a 3, 4, 5%, which is very worrying and probably means that they're going higher. But there you go, that's another indication what's going to take you up in the S&P, and our favorite sector is still XLK. XLK has quite a bit of room to run. It could do a 4 or 5%, and that is why the tech-heavy NASDAQ is still our preferred long, even from a fundamental point of view, but also from a technical point of view. So XLK we shall stick with and see what happens. Materials, well, materials are very close to the top, but they could certainly help. Remember, we're not looking for a huge move in S&Ps. We're looking for a move to 310, 320. So that is only 2% away from where we are at the moment. and we probably think that that wave will be finished. So fundamentals are still supportive of a small move higher, and they don't indicate that we will, at least the sectors don't indicate any immediate danger. Another indicator of the possibility of an up move in the US is, or the probability we should say, is how contained the pullback from 33.25, which is a level we've often mentioned in the Stocks 500, has been. It has been in a very, very tight 1% range. We would have expected more of a correction from the 33.25 level, and probably now we are going to have quite a powerful move away from it. We would not be surprised next week to see a move up to 3,400, and therefore that should be reflected in ES as well. This is a very powerful formation here. 3,400 still definitely seems to be on the cards over the course of the next 1 or 2 weeks. Very surprising, and but a huge sign of strength. Bund and BTP land are doing absolutely nothing. Up and down within a very tight range, which tells us that any movement in currencies is actually going to be caused by a movement in US yields. European yields are dead. The ECB is controlling the downside, but nobody who is sane wants to be long of those instruments. Therefore, that is the reason why we have such a tight range in those instruments. In Europe, people have more or less given up trading them. There is no point in trading something which trades within 100 to 200 point range, because unfortunately you never know when it's going to break out of the range. It is a bit like Euro Swiss was a few years back. There's only one buyer, and that is the SNB. There is a multitude of sellers, but the SNB is stronger than everyone else, and that is the situation that we have in bonds and in BTPs. The European Central Bank will not give up on the buying just yet. On the other hand, nobody sane wants to be long. All we know is that one day the ECB will change its policy, and that day whoever is long of European fixed income is going to basically bust his account. Therefore, no reason to even look at these. Actually, we look at them every day, all day, but they are telling us that for the foreseeable future they're dead, and to look at the US fixed income for any move that is going to impact the dollar, rather than look for Europe to do anything at all. Our biases for next week are actually refined further by the price action this week. 5 and 10-year notes. Well, the 118.08 level has indeed proved itself to be very significant. We are very happy with it and see no reason to change it. We can even now underline it. It's become a very important line in the sand. Close above definitely proves our bias to be short around that level wrong. Close below 117.08, 117.13 will actually signify the beginning of a new wave down. Now, in 10-year notes, any close above 125.09 is very, very worrying and has potential to squeeze all the way up to 128, the figure. Don't forget that the market is very, very short. Fundamentally, being short is the way to be. Even technically, the alignment, as we saw earlier, between the hourlies and the dailies is beginning at the early stages of becoming a confluence. But the market being this short really makes us very, very uncomfortable. But there you go. In bunds, we will be very patient and only short around the 3 to 6 basis points level, which equates to 165.50 to 166 area. We are quite a long way away from there, and we don't foresee that the market will get there, certainly not next week. ES, very little sustainable upside. We think it can get to 2300, 2320. But that is nothing compared to where NQ could go. And now we have our lines in the sand. 2240 for ES, below it we will be short. NQ, we give up on any longs below 4900. If we see a confirmation of ES below 2240, we are quite happy. We will prefer to be short at below 2240 than in NQ below 4900. And Russell 2000 is the one that we see as the most that has room to run the most in the long term. NQ has at the moment more room to run than Russell. Russell will take over leadership at some stage, but that is actually quite dependent on Trump delivering on some of his promises. Closed below 1346 in TFH 16, confirmed by NQ in ES, will confirm a major reversal. We would rather not be short of Russell and look for level for long-term buys in Russell unless Trump proves that everything he said during the campaign is a complete load of rubbish. European equities, we still prefer them fundamentally over the US, certainly over ES, rather than Russell and NQ. They're still at 33.25, so aggressive longs of poor risk reward. On the other hand, if the market now pushes significantly above 33.25, it will mean that they are running for another at least 2 or 3%. And again, fundamentally, we have to be long or US dollar volatility, because everything that we have shown you tells us that the moves in the 5 and 10-year notes within a few days or weeks are going to be very violent. Either we get the beginning of a very, very big continuation move down in the contracts, or we have a very large squeeze in the in 10-year notes and 5-year notes, which could result in a move at least to 110 in the euro on the upside, or at least to parity on the downside. So we are still very happy being long volatility for the time being in the US dollar. That is all we have for you today, but we have, please note down these levels. They're very, very important, and they will dictate our actions. Waiting for these setups is very, very important. We have to be patient, because the market is going to reward us mightily for our patience. Thank you very much indeed. See you Monday morning.